I want you to picture a scenario. You're in charge of building something massive, maybe a new bridge, a power plant, or even just a high-end office block. The budget is, let's say, $100 million.
The stakes there are incredibly high.
Extremely high. And things actually seem to be going well. The
Yeah.
trucks are moving, concrete is pouring, the contractor is sending you these invoices every month for $5 million, and you're just paying them. You think to yourself, well, we spent half the money, so we must be halfway done.
Which is the classic mistake. I mean, it's the trap everyone falls into.
Right, because then month 6 rolls around,
Mm-hmm.
and you actually walk onto the site with your hard hat on and you look around and realize only the foundation is done. You've burned through 50% of your cash, but you've only actually built maybe 10% of the project. You are now heading straight into a financial black hole.
That is the absolute nightmare scenario. And honestly, it happens constantly in construction. It's the primary reason these mega projects go bust.
So today, we're doing a deep dive into the cure for that nightmare. I've got a document in front of me that, on the surface, looks incredibly boring. It's literally titled Employer Requirement Cost Control, document number E3.3. It sounds exactly like administrative homework.
It really does. It looks like a dry list of rules written for accountants. But if you actually sit down and read the clauses, it's not homework at all. It's a survival guide.
Exactly. This is the financial nervous system of a major project. Our mission for this deep dive is to decode this document. We're going to look at how the employer, meaning the person actually paying the bills, forces the contractor to prove that they aren't just spending money, but actually delivering real value.
And that distinction between just spending money and delivering value is the whole ballgame here.
So for you listening, even if you aren't managing a billion-dollar mega project, stick around. Because the psychological shift this document forces, learning how to track value instead of just tracking your spending, is something you can apply to your business, your own home renovation, or even just your personal productivity.
Absolutely. Once you grasp it, it completely changes how you view progress.
We've got 4 main pillars to get through today. First, the map, which this document calls the cost breakdown structure. Second, the pulse, which is earned value reporting, and that is the real aha moment of this document.
Oh, definitely.
Third, we'll cover the changes, looking at how to handle the total chaos of variations and claims. And finally, the receipt, which is a surprisingly aggressive section on how invoicing works.
Let's start right at the beginning with the map.
Right, so we look at section 2.1 and 2.2. The document jumps right in and basically demands that the contractor create a cost breakdown structure, or CBS.
Yes, and it's definitely not a polite request.
Not at all. It says the purpose is to demonstrate internal checks and sound control of monetary transactions. It explicitly mentions being ready for an audit. Why is the language so heavy right out of the gate? I mean, why not just ask the contractor for a standard budget?
Well, because a budget is usually just a big singular number. Like, hey, I'll build this power plant for $100 million. The problem with a big number is that it hides a multitude of sins. If a contractor just gives you a lump sum, you have absolutely no idea if they're buying high-quality materials or if they're just using your money to pay off the debt from their last failed job.
So the cost breakdown structure is about taking a sledgehammer to that lump sum and breaking it apart.
It's all about granularity. Section 2.4 gets really specific about this. It says the contract price must be broken down by key assets, and it lists examples like site infrastructure, buildings, interconnecting units.
I saw that. It's asking for physical buckets of money, basically.
Exactly. It prevents what the industry calls front-loading. Without a CBS, a contractor might bill you $2 million in the very first month for something vague like mobilization. Basically, they're charging you for showing up.
Just to park their trucks on the dirt.
Right. But if you have that cost breakdown structure, the employer can look at the map and say, wait a minute here. The bucket for site infrastructure only has $500,000 in it total. Why are you billing me $2 million?
So it forces the financial reality on paper to match the physical reality in the dirt. It stops them from stealing money from the roof bucket to pay for the foundation bucket.
Precisely. It locks the money to the specific activity. And notice what it says in section 2.2 about personnel.
Yes. It says the contractor's organization must include experienced and qualified cost control personnel.
Which is a very polite corporate way of saying, do not let the intern do this job.
Get a grown-up in the room.
It really is.
Yeah.
The document is acknowledging that cost control isn't just data entry. It's not just taking receipts from a shoebox and typing them into Excel. It requires real analysis.
You need someone who can actually interpret the data.
Exactly. You need someone who can look at that bucket for interconnecting units and understand if the spending rate actually makes physical sense. If you put a junior person on this, they'll just dutifully record the numbers. But a qualified person questions those numbers.
And this map, the CBS, it isn't static, is it? The document mentions in Section 2.4 that this structure starts off in the project execution plan, but then it constantly has to be updated.
The update loop, this is crucial. Section 2.4 says it must be updated with every single progress report and every approved variation.
So if the plan changes in real life, the map has to change on paper.
Immediately. In poorly run projects, you always have the real budget, and then you have the official budget from 6 months ago that everyone completely ignores.
Right, sitting in a binder somewhere.
Exactly. But this document expressly forbids that. If you approve a change order to, say, add a new security facility, that new bucket of money has to appear in the CBS immediately. The map must always reflect the territory.
Okay, so we have our map. We've broken our millions down into specific asset buckets. Now we get to the part of the document that I think is the most intellectually interesting. Section 3, Earned Value Status Reporting.
This is the core concept. Honestly, if you take one thing away from this whole deep dive, it's this.
So Section 3.1 states the purpose. It says the Earned Value Status Report shall show the contract value of the works executed. And then it has this little parenthetical that says Earned Value of Contract Price. Help us out here. How is this fundamentally different from just tracking your costs?
Okay, let's break it down. Most people, and actually most businesses, just track actual cost. Say I go to a hardware store, I buy a bunch of lumber, and I spend $500. My actual cost is $500.
Simple enough. The money has left your wallet.
But earned value asks a much harder question. It asks, what did I actually accomplish? If I bought that lumber, but it's just sitting in my driveway under a blue tarp, my actual cost is $500, but my earned value is mathematically zero. I haven't built a single thing.
You've just converted cash into inventory. You haven't converted it into actual progress.
Exactly. And in a billion-dollar mega project, that gap between inventory and progress can destroy you. You can spend tens of millions on steel and labor, but if those workers aren't actively assembling that steel into the finished bridge, you aren't earning any value. You're just burning cash in a pile.
And this document demands that this concept be visualized, not just talked about. Section 3.4 describes the cost curve. It literally tells the contractor to draw a graph with 3 very specific lines. I want to walk through these because they tell such a clear story.
Let's do it. These 3 lines are basically the holy trinity of project management.
All right, line number 1 is planned earned value. The text describes this as the CBS against the planned progress curve.
That's your baseline. That is the initial promise. It's the contractor saying, by February 1st, we promise to have all the exterior walls built. That's the plan everyone agreed to at the kickoff meeting.
Then we have line number 2, which is actual cost. The text defines this as actual expenditures at measured points in the project.
That's the checkbook. That's the money physically leaving the bank account to pay the carpenters, pay the concrete supplier, pay for the cranes. And spoiler alert, this line almost always goes up.
Right. And finally, line number 3, the ultimate truth teller, actual earned value. The text defines this as the CBS against actual progress.
This is where the rubber finally meets the road. An independent inspector goes out to the site and looks at those walls. Now, maybe the original plan said the walls would be done by today, and maybe you've already spent enough money to finish those walls, but the inspector looks and sees the walls are only halfway up.
So if you look at the graph, your actual cost line is soaring high, but your actual earned value line is stuck down low.
And that gap between the 2 lines, that's called variance. And in this specific scenario, it means you are over budget and you are behind schedule. You are bleeding. If those 2 lines diverge significantly, your project is dying.
It's so interesting that the document forces them to plot all 3 lines together. Because if you only looked at actual cost versus your planned value, you might sit in a boardroom and think, hey, we spent exactly what we planned to spend this month. We're perfectly on track.
Right. You'd say, we spent the budget, so the work must be finished. It sounds ridiculous when you say it out loud, but without that 3rd line, without the earned value line, you can totally delude yourself and your investors for months. This document strips away that delusion entirely. It forces you to look the cold, hard reality of what you actually got for your money.
And it's pretty rigorous about how you prove that reality, too. Section 3.2 says the contractor has to explicitly show the methodology used for calculation.
They are basically saying, show your math. You can't just stand on a hill, eyeball the site, and say, looks about 50% done to me.
Right, no, trust me, I'm a professional app.
The employer doesn't want trust. They want verifiable data. Did you physically count the bricks? Did you measure the exact cubic meters of concrete poured? Did you count the linear feet of pipe installed? The document is demanding that the earned value number be derived from hard physical measurements, not just an optimistic guess.
Because if you let people guess, they will usually guess optimistically.
Always. Human nature is to say, oh yeah, we're basically almost done. The methodology requirement forces them to actually prove it with tape measures and tallies.
It also mentions that this cost curve has to include agreed variations and even pending variation proposals and claims.
Which perfectly leads us into the chaos factor of the project.
Yes. Section 4, reporting on variations and claims. Now, just to set the stage for you listening, a variation is just a change order, right? Like move this wall over here or use a different kind of tile.
Correct. It's a change to the scope. And a claim is usually a massive fight about money. It's the contractor saying, hey, we hit solid granite bedrock we didn't expect. It cost us an extra month to drill through it, and you owe us $5 million.
Now, the document notes that the actual process for fighting those specific battles is located in a completely different document called the Contract Administration Requirements. But here, in the cost control document, the entire focus is just on visibility. Section 4.1 says the purpose is to show the actual state of proposed variations and issued claims.
Think about why they want this here. If I'm the employer, the thing I hate most in the world isn't spending money. It's surprise spending.
You want the bad news as early as possible.
I want the bad news instantly. This section is essentially demanding an early warning radar system. If the contractor is even thinking about claiming extra money, if there is merely a pending proposal sitting on someone's desk, I want to see it tracked on this month's report.
Even before it's been negotiated or approved.
Yes, because if I can see a huge $10 million claim coming down the pipeline from miles away, I can prepare for it. I can negotiate. Maybe I can cut the budget somewhere else in the project to pay for it. But if you hide it in a drawer until the very end of the job and then drop a massive claim on my desk when I have no leverage, I'm dead.
So Section 4 is really about dragging all those hidden financial liabilities out of the shadows and putting them squarely on the table under a bright light.
Actual state. That's the key phrase in the text. Is the claim pending? Is it rejected? Is it approved? The document forces the contractor to treat a potential claim as a concrete financial reality that needs to be tracked, not just a rumor floating around the side office.
It aggressively creates a no-surprises culture.
Exactly. You are allowed to have bad news, but you are absolutely not allowed to have surprise bad news.
Okay, let's move to the fourth and final pillar. The physical work is done. The value has been earned and measured. The claims are all reported. Now, the contractor just wants their check. We are looking at Section 5, reporting on invoicing.
The receipt.
I really expected this section to be incredibly simple. Send the invoice, get the money. But Section 5.4 outlines a very specific deliverable called the invoice register. And the level of granular detail it demands is, honestly, it's intense.
It has to be intense. You have to remember, on a project of this scale, there isn't just one invoice a month. There are hundreds. From prime contractors, subcontractors, suppliers, specialized consultants, they get lost in the mail. They get stuck under a coffee cup on someone's desk. They get disputed.
So this register seems specifically designed to stop the whole "the dog ate my invoice" excuse.
Exactly. It's a rigorous tracking database. It's not just a stack of loose paper. It's a living, breathing log of every single dollar requested on the project.
Let's look at some of the specific requirements in Section 5.4. It asks for the standard stuff you'd expect, statement number, invoice number, the amount, but then it explicitly asks for invoice type, and it lists progress, milestone, or variation.
That loops right back to our map, the buckets. You can't just send an invoice that says for services rendered. You have to tell the employer exactly what this is. Is this a standard progress payment for the main contract? Is it a bonus for hitting a specific milestone early? Or is this a bill for that specific change order we argued about last week?
It forces a connection between the money being asked for and the map we drew in the beginning.
Right. Because if you send me a bill for a variation, but I look at the system and that variation hasn't been officially approved and entered into the CBS yet, the accounting system just rejects it automatically.
And then there's this really specific requirement. It asks for the accounting code, and it gives the example of an SAP PO number or line item number.
That right there is the pure language of corporate bureaucracy.
Explain that for us a bit. What exactly is SAP?
SAP is this massive, complex enterprise resource planning software. It's what almost all the giant global corporations use to manage their money and supply chains. By forcing the contractor to put the employer's internal SAP code right there on the invoice register, the employer is essentially saying, help me help you.
It's basically making the contractor pre-fill the employer's internal paperwork.
Yes, exactly. If you put the correct SAP code on your line item, my corporate accountant can process that payment and wire the funds in 5 minutes. If you don't include it, or if you guess and use the wrong code, that invoice is going to sit in a digital inbox for 3 weeks while some clerk tries to figure out which department's budget it comes from.
It sounds incredibly tedious for the contractor, but it actually speeds up them getting paid.
It greases the wheels. It completely removes the friction of an accountant saying, I have no idea what this charge is for. I'm putting it in the pending pile.
But there is one column required in this register that really caught my eye. It's item L in the list. Days overdue.
Ah, yes. The name and shame column.
I couldn't believe this. The document literally forces the contractor to track and report if the employer is late paying them.
It's a really fascinating inclusion, isn't it? Usually these requirement documents are entirely one-sided. They are all about controlling the contractor, do this, report that, measure this. But this specific requirement turns the mirror right back on the employer themselves.
Why on earth would the employer put a metric in their own rulebook that highlights their own failures?
Because smart, experienced employers know that cash flow is the oxygen of a construction site. If the employer's accounting department stops paying the contractor on time, the contractor eventually stops paying the guys swinging the hammers. And if they stop getting paid, they walk off the job. And then your $100 million project grinds to a halt.
So if that days overdue column starts filling up with big numbers week after week,
it acts as a massive red flag for the project leadership. It tells the executives sitting in the glass offices, hey, our own internal accounting department is bottlenecking this project. We need to go down there and fix this before the steel workers walk off the site. It creates a level of accountability on both sides of the table.
it forces a shared reality.
That is the overarching theme of this entire section. Look at item F on that same list, IPC approval date. IPC stands for Interim Payment Certificate. That is the exact moment the independent engineer officially signs the paper and says, yes, this physical work is good and complete. By tracking that specific date in the register, both sides have to agree on exactly when the clock started ticking for the payment window.
So there are no more arguments about, oh, I mailed the invoice on Tuesday, or, well, I didn't actually receive it on my desk until Friday.
The data is right there, crystal clear in the register. It totally removes the ambiguity that usually causes lawsuits.
When you step back from the weeds and look at document E3.3 as a whole, it's really doing something quite profound. Construction by its nature is messy. It's mud, it's sweat, it's unpredictable weather, and it's constant arguments. But this document tries to take all of that physical chaos and turn it into clean, manageable data.
That is the true essence of it. It transforms the act of construction into the act of control. Without a document like this, a mega project is just a series of frantic phone calls, yelling matches, and surprise bank transfers. With this document, it becomes a managed, predictable system.
It really forces the contractor to think differently, too.
Yeah.
They can't just be builders with hammers anymore. They have to act like analysts.
They have to understand that providing the data is just as important as pouring the concrete. If you pour 1,000 yards of concrete but you don't track the earned value properly according to the rules in the eyes of the employer, you haven't really done the work. The data is the proof of the work.
So, for you listening who have been with us through the intricacies of the cost breakdown structure, the 3 lines of the earned value curve, and the intense scrutiny of the invoice register, why should you care? What is the core takeaway for someone who is absolutely never going to build a skyscraper?
I think the main takeaway is that cost control, in its truest sense, isn't about being stingy. It's not about just refusing to spend money.
Right, because you have to spend money to build things. You can't just hoard your cash and expect a bridge to appear.
Exactly. True cost control is about alignment. It's about ensuring that every single dollar leaving your bank account corresponds directly to a tangible unit of value appearing in the real world. It's about knowing the crucial difference between mere activity and actual achievement.
And that actually leads me to a thought I've been having since we started reading this source material. We all have budgets in our personal lives. We all track our actual cost, rent, groceries, endless monthly subscriptions. We look at our bank app and see exactly what went out.
Sure. We are very good at tracking the outflow of cash.
And we all have plans, too. Our planned value, I'm going to finally write that novel, or I'm going to get in shape, or I'm going to launch that side business this year.
We all have the plan, and we all know the cost.
But do we ever rigorously measure our own earned value?
That is a very provocative question.
If you treated your own day like a construction project, sure, you spend 8 hours sitting at your desk at the office. That's your actual cost. You set the time resource. But what was your actual earned value for that day? Did you execute the works? Did you actually build the thing you said you were going to build when you woke up?
Or did you just answer pointless emails and move digital papers around your desktop?
You know, in the corporate world, we call that churn. It looks exactly like work. It certainly costs time and energy. But the earned value of churn is zero. You haven't actually advanced the project of your life or your career.
It's a really tough metric to apply to yourself. To look in the mirror at the end of a long day and admit, I spent the resources, I'm tired, but I didn't actually earn any value today.
It is tough.
Yeah.
Really tough. But if you want to actually get important things done, whether that's constructing a billion-dollar power plant or just finally cleaning out your garage, it might honestly be the only metric that actually matters. Measure your earned value, not just your time spent. I really like that. Something for you to think about the next time you're reviewing your own personal invoice register.
Indeed.
That's it for this deep dive into the fascinating world of cost control. Thanks for listening, and we'll catch you on the next one.
If you're interested in the templates, please visit our shop. The link is in the description.
Thanks for watching. Please subscribe and see next time.